All right. Let's start hitting some Chapter 8 questions. We'll go through, make sure we hit direct costing kind of backflush questions, and there are a few varieties of those, and they don't vary all that much, though. And some throughput accounting backflush questions. Very similarly, there are a few varieties, but they don't vary all that much. In fact, a good number of the direct costing and throughput accounting questions, if I remember the test bank correctly, are just copied over. Just the bolded word is no longer direct costing, it's now throughput accounting. And then we'll make sure we hit some of the capacity variance questions, because those are a little different than the others. And so let's go straight through. Let's just look at each the whole 10 questions if we can here. All right, so this one right here. First of all, I see a bolded word, it's direct costing. Okay, so it's probably going to be a backflush question using the direct costed inventory valuation method, meaning what do we count as an inventoriable cost or a product cost? Well, we're gonna count under direct costing or under variable costing. We count direct materials, direct labor, and variable overhead. It's almost always true that direct materials and direct labor are considered to be variable costs because they vary directly with volume, generally speaking. And then, of course, variable overhead, variable is in the name. So that's why it's direct costing or sometimes variable costing. Only variable costs are considered to be product costs in that setting. And so, yeah, okay, so that's our definition. And I can look at the table here and see, so total direct materials cost is given, total direct labor cost is given. Those are both product costs. And then we're given total fixed overhead. Is that a product cost under direct costing? No, it's not. It's excluded. So I'm probably going to want to ignore that, and some of the answer choices are going to try to tempt me to include that. All right. I also see I have a total number of units. When you get these questions, just see that when you get a total number of units, we're always going to use that as our denominator to create rates, just about always. It's like if you see a TEU in a process costing question, except we're making it a little simpler. There's no such thing as equivalent units here, just total units that we're talking about. Total complete and in process. I also have a number here, ending raw materials is 0, so that suggests to me that this problem is going to be simpler. I don't have to worry about the portion of RIP, just worry about the in-process portion of RIP, if anything. All right, so it's asking now, let's see. Oh, it also gives us some units in finished goods and units in process. So the basic mechanics of the backflush is all the costs are accumulated first in cost of goods sold, and then at the end of the period, after the end of the period, we do a manual count, which is what this little line is about. Manual count of units in finished goods and in process, because those amounts should be very small, so it's not worth it to perpetually be updating those throughout the period. We just make the counts at the end. And because that's the lean part of lean accounting here. And then we're going to take those total amounts up here, get rates out of them, and multiply them by these units to figure out how much we're going to backflush to finished goods and the correct in-process accounts. Right, so which journal entry appropriately backflushes cost inventory accounts? That's what it's asking for. So we can do a little bit of work here that's just journal related. This is where your accounting knowledge increases your odds by 50%. Well, doubles your odds. There we go. So 2 of these entries, these options, debit cost of goods sold. 2 of them credit cost of goods sold. Which 2 can we eliminate? They can't both. There's a categorical way in which 2 of those must be wrong, because one of those is wrong. You would never do that for backflushing. If you got a guess, which one seems like you would want to do that? Yeah, which one's eliminate? Yeah. Good. That's the right educated guess. That's the right answer. Yeah, good. So those first 2 are definitely wrong. Okay, when I say we're accumulating costs during the period in cost of goods sold, that means we are going to be debiting the cost of goods sold as we go along to the period. As we incur that $1,500, that's a debit to cost of goods sold and a credit to the accounts payable for those direct materials. When we incur $500 of direct labor costs, that's a debit to cost of goods sold, $500, and a credit to the wages payable. And so we're accumulating all those costs in cost of goods sold, debiting it throughout the period. So when we backflush, we're carving away some of those costs. We have to do the opposite of that. We're crediting cost of goods sold. And if it helps, we're also putting the right cost into the inventory accounts. And so we're going to be, I don't know if that's the right answer. Sorry, didn't mean to click it. We're going to be debiting those inventory accounts, which are RIP and conversion costs and finished goods here. We're ignoring for a minute the idea of, well, there might have been an inventory level before, beginning balances inventory counts, and we're debiting to them. We should be just let's keep it nice and simple. We're not going to go into the depths about how exactly a lean accounting firm would deal with the fact that there's an existing balance potentially. Just imagine that all these balances are at zero, these inventory accounts, and we're back flushing the right amounts to account for what's in there right now. Okay, and so as a result of this, C or D has to be the right answer, one of these two. And if you want to make an educated guess, notice that down here, conversion costs and finished goods are higher than up here. I told you that I was probably going to tempt you with that fixed overhead cost, right? Because I'm testing whether or not you know what direct costing means. Would you include this 500? Well, if I just had to guess without doing any of the calculations, my money's on C, the one I accidentally pushed the button for, that's the right answer. Because it debits and credits the right accounts, and comparatively, it has a lower amount for conversion cost and finished goods. Those are the two that would include overhead if we were including overhead. So I'm probably tempting you with an extra amount going to conversion costs and finished goods if you incorrectly include that $500 of fixed overhead. So let's go through the full calculation here, and it won't take as long as it sounds like. In fact, let me see if we can grab and copy. Look at that, so nice. Okay, and we have, so I'm going to create rates for this. Whoop, let's take the units out of that. I'm going to create rates for this right here. I've got to expand. There we go. All right, so per unit, we have 15 cents for direct materials, 5 cents for direct labor, and we would have 5 cents for fixed overhead. In fact, let me go ahead and delete that, just not even, not product cost, not a product cost. Okay, great. So we're going to be, our debit to RIP is going to include the portion and the IP portion, meaning direct materials or raw direct materials, which we know is $0. Right there, I told you ending raw materials is $0. We went through, did a count, the warehouse is entirely empty. The IP portion, meaning direct materials cost of in-process units. So I will just move these over so we can actually read the full text in those cells without resizing the columns crazily and affecting all the downstream problems. It is going to equal our direct materials rate times the number of units in process, which is given here right here in the problem, 25. No. 25. There. Okay. 25 units in process is given in the problem. Okay, that was Shift F2 if you want to learn keyboard shortcuts. F2 enters cells, Shift F2 adds a comment to a cell. So, great. Doesn't actually help us differentiate, doesn't change our estimation here. We know that the total debit to RIP is going to be, in this case, just $3.75, if we could learn how to use decimals. And then our debit to conversion costs. Remember, a lean accounting firm is going to try to separate out the inventory accounts differently, not direct materials, WIP, finished goods. It's going to take RIP to be direct materials that are raw and in process, and then conversion costs, which are the conversion costs incurred for in-process units, and then finished goods stays the same. So conversion cost is going to be our direct labor cost plus our variable overhead cost per unit, which is 0. We have no variable overhead in this problem. So our 5 cents for direct labor per unit times, again, the same number of units in process, 25 units in process. So I could even put in here, I'll do it again. we want this plus 0, just to be pedantic about it, times 25. The 0 there is effectively no variable overhead. If there were a variable overhead rate we were given or we calculated, then we would include it right there, right here, times 25. Oh, $1.25. Looks like I was right, that this is the right answer here, because this does $1.25, this does $2.50. If we incorrectly did direct labor plus 5 cents for the fixed overhead, if you remember that 500 over that 10,000 is 5 cents for direct overhead times the 25, that's when we get the 250. Again, yeah, I was tempting you to include the $500 fixed overhead cost, which you don't, because you know what direct costing means when you're using that. So that would be incorrect. This is the debit to conversion costs, and so the debit to finished goods, which isn't required for us to answer this question, but it might be for different questions you see on your quiz, is going to be, well, they're finished. So they have direct materials, direct labor, and variable overhead. Well, we have no variable overhead, so they have direct materials and direct labor in this problem. So they're going to be both these rates times the number of units in finished goods. Oh, 35. So it should be that $7 right here. And it should not be that plus 0.05. No, that's not going to work. It's not going to like that. There. You'll like that. Times 35. This is where you get the wrong answer right here. 8.75 is when you include direct materials, direct labor, and a 5 cents per unit for fixed overhead. You incorrectly include that, you get 8.75. Okay, so that should be our debit to finished goods. And then our credit to cost of goods sold is going to be the sum of our debits. Just honestly, we're trying to get a plug number here sometimes. These are the calculating numbers. This is our plug number. If you prefer, you can calculate the COGS number. We'll do a little check figure right here. You can calculate it by saying, well, between our RIP, our conversion costs, and our finished goods accounts, we're going to include all product costs for all the units we counted, raw, finished goods and in process. So all 60 units here, 35 plus 25 is 60. For all 60 units, we're going to multiply them by each product cost related rate. We get, some of that, sorry. And we should get $12 again. In fact, what I wanted to make a real check figure is, check figure should be 0. Okay, great. I'm going to contrast that separate way of calculating the COGS credit with the way we got our primary way of getting it. So the difference between those two is 0. That means a passing check figure. Great. All right, the logic there, okay. If not, let's move on to the next one, and hopefully it'll hammer out. So this is the right answer here. All right, again, a direct costing question, and I gave you rates. Look at that. Note that some of the amounts below are on a per unit basis. I put this in here so that you don't get into blind mode and say, oh, well, I always take the DM number and the DL number and I divide them and so on. No, I'm trying to give you an extra reminder that, hey, this is a per unit number. I've already given you the rate, cost per unit for this. All right, so what exactly is it? Oh, asking again for journal entries that backflush correctly. So which two can we remove? The debit to COGS. Yes, that's not going to be ever right to backflush by debiting cost of goods sold. We're going to reduce the cost of goods sold. Cost of sold is an expense account. It goes up with a debit. So to reduce it and put some of that debit balance into the balance sheet by backflushing to the inventory accounts, we're going to have to credit cost of goods sold. So let's grab this table here. Should paste nicely. It's not gone so far so good. We'll make sure if we need that, we have it available as a number instead of as characters. And it looks like we also have information here, $50 of raw material. So raw material count is $50. All right, so I also have this parenthetical right here. This $50 is not included in the above rate right here. If you look at 2023 videos, I had not made this fix. Now the questions are very clear that this $50 is not part of the numerator that went into this rate. So if you're following closely, and maybe not now, but maybe later, and you're really into chapter 8, or by the final, you're really thinking through it, and you've got the logic down. If we did that, if that $50 were here and in the rate, then we will be double counting in the debit to RIP. We'll have our portion, which would be the $50 in this example, using this old question's logic. But and then we have an in-process portion of RIP, which includes a rate that has part of it as that $50. So a small portion is double counted. Now, what I said last year, before I fixed all the problems so that never happens, now the problems always include these kinds of disclaimers, is that I'm okay. I was okay last year, and I still am okay, honestly, with that double counting, because a lean practitioner probably would be okay with that double counting. We're talking about fractions of a cent in this kind of problem. We're talking about small amounts of double counting in that case, and these numbers, we're trying to keep them as small as possible. So really, if we're doing our job well, the double counting should be a rounding error. And our lean accounting isn't going to be GAAP compliant anyway. It's entirely for internal reporting purposes. So if it doesn't matter to us for our own decision-making purposes, then we're not going to go through extra effort to make it true. Well, I've obviated that concern. If it were to bug you, if you see the videos from last year, maybe it does. It will bug you if you look at those. But because now the questions don't have any of those kinds of problems. Okay, so we know it's either A or D. And if this problem is also testing your knowledge of what direct costing means, then we could guess that it's probably A, because it has a lower COGS value. And maybe it's me testing whether or not you're going to include that fixed overhead rate in your debits to conversion costs and finished goods. Let's compare A and D a little bit more. Yeah, it looks like I have 275 for RIP, 225. Oh, there's more. There is a difference in fact, A and D differ entirely based on the RIP rather. Okay, so let me step back, and I said it wrong. Let me go back even 30 seconds to a minute. I said A was smaller COGS. No, it's not. It doesn't. Sorry, I was comparing the wrong number. So A has a larger COGS. All right. So this one differs from the previous one. We can't just guess. Let's go with a smaller amount because it's trying to get us fixed overhead. The finished goods and the conversion costs here, where fixed overhead would be included if we erroneously included it, they're the same. So it's not a question of that. So if I were using a different heuristic, I look at these answer choices and I'm trying to guess between A and D, because I know I ruled out these two because of the logic of the backflash entry. Well, why would RIP differ between 225 and 275? Is anywhere in the problem a $50 difference noted? The raw materials count. Yeah, I'm testing about whether you know what to do with the portion of the RIP. So if I had to guess, and we'll go through and double check, I'm guessing it's this 275, which would include the $50 probably, and not the 225, which is what we'll get without it. So we can do this pretty quickly. I think it'll be pretty quickly. If you hate this stuff, it'll be like pulling teeth even if I went lightning speed. So the direct materials entry, well, let's do it the same way we did this previous one. We get an portion and an IP portion, and then sum those together to be what we're actually using here. I'll highlight these. These are the actually used cells that reflect the entry. This is just a subtotaling. These are just subtotaling rows. And I'll just move, I'll move that to make it look prettier there. So this is the answer choice we did for question 1, and we're going to have an answer choice just like that we do for question 2. Let's make it look nice. Okay, so the portion is going to equal that $50 raw materials. This is the raw materials that we counted at the end of the period. And the in-process portion is the rate for direct materials times the units in process. So that is our correct answer for, labeled it wrong. Did I do the wrong? Oh, I labeled it right up there. That's our debit to RIP. We have an portion and an IT portion equaling 275, which is why this is the right answer. Now, for conversion costs, we're talking about direct labor and variable overhead, that are incurred for in-process units. So the sum of those two rates, $1.25 and 65 cents, times the 100 units in process, gives us 190. That's why this is 190 in both answer choices, but in the correct one, it's 190. And then finished goods is all of the product costs, rates, multiplied by the finished goods units we counted. Whoop. Times, there we go, times that. So we get 622.5 as the right answer for our debit to finished goods. And just as a plug, we can sum those debits to figure out how much we have to credit to cost of goods sold, 1,087.5. Great. Let me label these. I don't think it's happening there. This is question 1. Direct costing, total costs. Yeah, we'll put it over there. This is question 2. Direct costing, rates provided. Okay. Now question 3. So this is asking a slightly different question, so we'll go through it. Question 3. Finished goods balance after backflush. Backblush. Which of the following is the finished goods inventory balance after backflushing costs? All right. Like I think I do with every single question, I give it a 0 balance to begin with. I've given you rates. These are the unit direct materials cost, unit direct labor, unit variable overhead, and we know it's direct costing. So which of these 4 are product costs under direct costing? All 4? I heard no. Correct. Not all 4. Yes, that's it. Those top 3. Direct materials, direct labor, and variable overhead. Excellent. So what we can do is we can simply say, let's take those 3 rates, multiply them by the units that are finished. We gotta figure that out though. Oh, okay, there's a little bit of math required. All right, so let's start by copying the table over, and the math won't be as hard as it looks if you're confused about what we're doing. So first of all, we could, this is the better way you would like to calculate, we could sum the rates up here. Stop. This is our per unit cost, like for finished goods, total per unit cost. Oh. There we go. Such as for finished goods, $28 per unit. All right, we have 10,000 total units, 9,650 of them are sold, and 150 of them are still in process. So basically, by process of elimination, the numbers of units that we finished, they're not in process anymore, they've finished them, but they're not sold yet, which would be the inventory that's in finished goods, is at 10,000 units minus 9,650 minus 150. What? So I didn't convert this into a number. There we go. So 200. We can double check that. Looks like these 3 together sum to 10,000. Good. Well, we've got all units accounted for. We sold 9,650 of those 10,000 units. 150 of them are still in process, which leaves 200 that are finished but unsold, which means they go in finished goods. I'll move that over here so that we can read the whole cell. So we're going to take that number, multiply by that number. So multiply the number of units in finished goods by the total cost per unit, or total per unit cost, and we get 5,600. And so that is our backflush debit to finished goods, and the correct answer, because we have a 0 beginning balance, we're backflushing in 5,600 to it, and therefore the balance for finished goods is 5,600. Yeah, it's the total units number, is 10,000, minus the number sold, units sold, minus the in-process units. Yep. Exactly. I varied the process a slight bit here. I summed the rates up here and labeled it. Up every time up here, I've been summing them in the cell. So and the same thing for finished goods debit here. I sum these rates in this cell and multiplied it by the units in finished goods. Here we had to come up with the units in finished goods, and I just changed how I created a separate cell with this number in it. Questions on 1 through 3? Moving on. Okay, now I just want to point out here, this question is very similar to question number 1, and we're going to skip it. However, I go out of my way to make sure you don't confuse it with question 1. I say, look, it does, and capitalized, bolded, italicized, everything but underlined. And I say, look, don't automatically see this line and think, oh, that must be fixed overhead, because I saw a question with exactly the same numbers a second ago that had fixed overhead right here. Nope, this is variable overhead. So should we include that under direct costing? That is a product cost under direct costing, so we should be including this. In fact, I bet the numbers are exactly the same. It looks like all the numbers are the same, including here. So I bet whatever the answer wasn't up here, yeah, it wasn't this in first question number 1 here, because that was including the 5 cents per unit that we made sure we excluded. I bet, since they're all the same numbers in this version of the question, here we go, that's the right answer. And we're going to go ahead and make that guess right here. Oh, no, I did it wrong. That this is it. In fact, holy cow, this is also testing a separate thing. Maybe I shouldn't have done this. I've also screwed up all the journal entries, so there's only one journal entry that could be it. Look at those goofy ones. Here's debiting COGS. Here's debiting COGS and RIP for some reason, but crediting conversion costs and finished goods. Here's debiting COGS, RIP, and conversion costs, but crediting finished goods somehow. And here it is exactly backwards. Debiting COGS, crediting RIP, and this is the only one just by journal entry. Okay, I'm not going to do the calculation of that one. We're going to move on. All right, so this is a different style of question. It's worth going over for sure. Question number 5. This is going to be asking you less about. This question is asking you about the timing of backflush. That's largely what this question is about, and what it means. Where are product costs accumulated, and then what is the timing of the backflush entry? So we're using direct costing basis here. We have no fixed overhead. The question sitting down here says, what is the balance of cost of goods sold account before backflushing to inventory accounts? So if we're before backflushing, do you think we have to calculate the backflush entry? Do you think maybe we don't have to? I guess, do you have hope that we don't have to? Some people have a little bit of hope. Good. I haven't crushed all of your hope, because that hope is right. Okay, remember the timing of backflush. We're going to accumulate during the period all costs and costs of goods sold, debiting cost of goods sold each time we have a product cost that's incurred, like this 19,112, this 16,448, this 18,321. Those are all being debited to cost of goods sold throughout the period. And then after the end of the period, we backflush. We backflush a few of the accounts by crediting cost of goods sold and debiting RIP, conversion costs, and finished goods. Well, before that happens, I'm simply asking you to, let me kind of give away the game, sum these. That's it. If you've got a decent understanding of what we do under a backflush system, that's really all the calculation I'm asking of you. I want you to sum those 3. Because cost of goods sold is where product costs are accumulated. That's one point. And those 3 types of costs, direct materials, direct labor, and variable overhead, are product costs under direct costing. So those 2 pieces of knowledge let you know what the answer to this is, which is just a sum of those 3. So let me copy those down. So we jump to question 5. COGS before backflush. COGS balance. So we have 19,112. We have 16,448. We have 18,321. And we have the sum of those 3 as 53,881. And I literally haven't read through any of this. I assume it would be important if we were calculating the backflush entry, but we don't need to, because I'm asking the question, what happens? What does it look like before you backflush anything? Well, we had $53,881 of product cost incurred this period. So those were debited to cost of goods sold. So that is the balance of cost of goods sold. I don't have to tell you the beginning balance because it's an income statement account. It's an expense account, which is zeroed out every period. That's the nature of those accounts. So the started balance was zero. Then we would have to go through and figure out the backflush entry, or at least how much the backflush entry is crediting to cost of goods sold. In which case, doing this method right here is probably going to be the easiest way to get to that. Instead of doing the whole calculation, just figure out how much is being credited to cost of goods sold. And we can do that. Well, let's just double check. Let's say a what if here, because I think there are some questions that ask that. What if it were after? It's a very good question, Heather. Yeah. So we have 33 and 22. 33 plus 22. These are units being debited to, basically, or debited to account for during backflush. Those are the 33 units in process and 22 unsold units in finished goods. We also have 926 is our raw materials count in dollars. The value of our raw materials that we counted is an addition to this up here, in case we were trying to calculate it. Have I created a complication by trying to get rid of double counting? Well, when you do this problem, don't include this 926 when you're talking about before. That's what I'm intending with that problem. I may have just created a new problem with this parenthetical. Whatever. All right, and so we also know we have 1910 is our total units. All right, so what we can do is we can take our total debits, divide it by the 1910, and that's our total cost per unit. And we know we're going to have to debit that total cost, $22.21 it would round to, for all 55 units that are being debited to in process and unsold. And so in total, this is the total amounts debited in finished goods to finished goods, conversion costs, and the IP portion of RIP. We add in that raw materials, and now this is the total debit. So if we take that away from our cost of goods sold balance before the backflush, this will be our cost of goods sold balance after backflush. Okay? It might seem like that's a lot of steps. Yeah, well, apparently I'm going to Z. Yes, up one more. Yeah, that one right there. Yeah, you need, yes, because the before balance reflects all of the product costs. I'm going to, because I don't have to, because I'm trying to be real simple with this, I'm just looking for cost of goods sold balance. I just want to know the total we're crediting cost of goods sold. I'm just going to merge all these product costs together, and this is the number that's all the product costs. So yeah, that ends up being the same thing, kind of by accident a little bit. But yes, you need that before balance number divided by total units, and that should give you the total cost per unit, which includes direct materials, direct labor, and variable overhead. And then you multiply that by the units that are in process and finished but unsold, and then add in the raw materials as well. Total debit in the back flush entry. So I'm trying to make things simpler by adding this little jump of logic. And maybe this isn't, maybe none of you have this question, and I'm just making not a molehill, but I don't know. My point is that you're debiting these three accounts. These two have the raw materials plus all the in-process units times total cost. And we have to separate those out. We don't do total cost. When we're doing the actual calculation, we need these two balances. This is in-process units times the direct materials rate. And this is in-process units times the conversion cost rate, which is the direct labor rate plus the variable overhead rate. But because I don't care about what these two lines are separately, I just need the overall amount we're debiting, because we're talking just about cost of goods sold. I'm trying to get at really how much I'm crediting here. I can just say, well, between these two, I have the raw material amount, the raw material count amount, and the total cost for those in-process units, which in this question is 33. And right here, I have the same thing. I have the finished goods units, finished but unsold units, times total cost per unit. So I've got the same thing, and I can sum those two, and that's just what I did. This takes up one cell, takes the in-process and the finished goods units, 55 right here, and multiplies them by this rate right here, which is just the total cost per unit rate. The overall structure of what we're doing is really simple. We're just going to take any unit and multiply the total cost per unit by that unit. It gets a full $28. The thing that makes it seem more complicated is that we do split it up, that $28. Part of it's going to sit here, part of it's going to sit here when it's in process. And we also add in the raw materials cost, sure. But overall, we are just taking every unit that we're talking about in process and finished goods and just multiplying the same $28 in this case by that amount. So if we can use that logic to cut the corners since we're just dealing with COGS, we just want this bottom number, and we can get that by figuring out what the total debit is here, then that's a simpler way of doing the problem than having to say, all right, let me go through and figure out direct materials rate. Let me get a direct materials rate and divide 19,112 by 1910 and get something like $10 per unit for direct materials. Let me go ahead and divide 16,448 by 1910 to get a direct labor rate. Let me go ahead and divide 18,321 by 1910 to get a variable overhead rate. And let me take direct materials rate multiplied by 33 to get the IP portion of RIP plus 926 gives me the total RIP debit. And let me multiply these two rates by 33 to give me the conversion cost debit. And then let me multiply the sum of all three of these rates by the 22 unsold units in finished goods to get me the debit to finished goods. And then I'll take the total of those, and I'll get this amount right here, 2477.54712. I get the same number in the end. And then I can subtract that away from the before balance in COGS and get the after balance in COGS. So I've skipped like 3 or 4 steps by not having to do the whole entry and just saying, I'm going to take all units multiplied by total cost and make sure I add in the raw at the end. And that will get me the total balance, the total debit side, which has to balance the total credit side of my backflush entry. A lot of words there. Hopefully more like a word poetry than salad. What's good words? Not a salad? You say word salad, that's like a negative thing. Poor salad. Man, it gets all the hate. Okay, this question is asking about before, so we can simply put in that. Great. If you get that question on your quiz, be like, oh, phew, I can forget all that useless knowledge about after, and you can just write that. Of course, then the next time you'll get after, and you'll be like, oh no, I forgot all that useless knowledge about after. Now I got to get that useless knowledge back. Okay, so 6, 7, 6 and 7, and 6, 7, and 9 here are throughput accounting questions, and then 8 is more of a general backflush costing question. So let's look at 6, 7, and 9, and 8 as well. We'll do the rest of the problems. My point is that we've got 6, 7, and 9 throughput accounting, 8 general backflush, and then 10 we're going to have this capacity variance question here. We can look at capacity variance. Did I say that right? All right, number 6 here. Sometimes I got the indentation for these entries in there. Sometimes I did not. I apologize, but I tried to label them all. Occasionally, I copied and pasted the labeling wrong, and you will get a credit. If you see that, please let me know. Sometimes it says credit instead of credit. I don't think I have any that say debit, but I might. If I copy the word over and I forget to change the D to a B or the B to a D. All right, so we're using throughput accounting. All right, what is the product cost under throughput accounting? Is it direct materials, direct labor, variable overhead, fixed overhead, all those? I'm going to think I heard a no. I think I saw facial expressions that suggest no. All right, is it like direct costing? Direct materials, direct labor, and variable overhead are considered product costs? I'm going to imagine I said a no then, heard a no then too, because why would you have two terms and you're bolding them, but they mean the same thing? So what is included? What is a product cost under throughput accounting? First try. Oh. Also first try. I'll clean. The only truly or totally variable cost is materials. Direct or raw materials. Okay. That does make these calculations quite a bit easier, to be honest. There's no conversion cost inventory account because conversion costs are not inventoriable. No direct labor, no variable overhead, or any kind of overhead is inventoriable under this system. So we are debiting finished goods and RIP. That's it. And they're both just going to be debited based on the direct materials rate. And RIP also includes, if we have a raw materials number, the portion for RIP. It really is simpler if you can get that flow chart down. Once I see throughput accounting, it's this set of processes I do. Those processes are indeed simpler than the direct costing set of processes. I don't know if that's the answer. Sorry, I just clicked on it. All right, so we're using throughput accounting, and it's asking which journal entry most appropriately backflushes cost. And I phrase it that way, I think, because technically, a lean firm could include a WIP account, could include different names of accounts. I'm trying to get at the point that it's stated in Chapter 8 that most lean accounting firms are going to rearrange their inventory to include a RIP account. And so most appropriately, probably not one that uses the traditional 3 inventory accounts. So that one I just accidentally clicked on now, I could probably exclude that. It says it's going to be one of these 3. I'm not going to play the game. Well, what can I do? Is it this one? Can't be that one also. Remember, you're not going to be debiting COGS when you're backflushing entries. You're always crediting cost of goods sold. Okay, so we know it's A or B. And oh boy. Well, actually, we'll see. We'll see what happens here. It's A or B. I see $50, and I'm like, RIP varies by $50 between A and B. But also notice the cost of goods sold. Oh, no, I got ahead of myself. That is it, yeah. So just by process of elimination, I'm pretty sure it's got to be this one. Let's do the calculation, double check. So question 6, if you didn't follow my logic there, let's just, you'll see it in a second. Question 6, through puts accounting backflush entry. And we have 10,000 total DM. We have 5,000 total units. So our rate, this is DM per unit, aka total cost per unit, since DM is the only truly or totally variable cost under throughput accounting, under the assumptions of throughput accounting. Okay, so we can exclude this, we can exclude this, we don't need to get our hairnet all messed up because, oh no, he didn't differentiate variable and fixed overhead. Doesn't matter. All overheads are period costs under throughput accounting, or considered that. Considered a variable a period cost, considered a period cost. Now, we also have this one calculation we have to do again, because I'm not given the number of units in finished goods. We can get that pretty easy though. We have 5,000 total units. 100 of them are still in process. And so I'll break it down to kind of flow through the logic a little better. These are the total finished units then, because if they're not in process, if we're total units, and we've excluded the ones that are in process, and the rest of the ones that are finished. But some of those are finished and sold, 4480 specifically, sold units. And some of those are finished but unsold, or finished goods units. So 420. So we're going to need to multiply that $2 by these two numbers to get the IP portion to RIP and the debit to finished goods. So debit, RIP. So IP portion equals 100 times 2. And lo and behold, there it is, tempting you. That's just the IP portion, though, apparently, because it also doesn't problem. We have $50 of raw materials, the portion of RIP. So our debit to RIP is $250. Our debit to finished goods is that $2 per unit times the number of units that are in finished goods, that are finished but unsold, 840. So that's why this line is 840 in both answers, but specifically the one that's correct. And so then the credit to COGS, as expected, is going to be 1090 right here. Okay. Yeah. I think I copied it over. Yeah, I just copied it right here. Sorry, I thought you meant in process number here. Yes, sorry. Yeah, that 100 times 2. So you said it, and I just went to the wrong cell. The in process portion, yes, is there right? You're good? Okay. So chapter 8 shares, doing well in chapter 8 shares similarities somewhat to chapter 7 in that your mental flowchart of what rules to apply is very important, because that was important in chapter 7. I think that the procedures, once you get that flowchart set, are simpler. I do think it's easier than chapter 7 goes. It better be. It's advertised as being lean and simple and plain English, right? All right. Chapter 7. Question 7 has a firm called NoFlush that we're going to do backflush on. Question 7, NoFlush. What are we asking for? COGS before and after. So my question, first of all, if I'm a student looking at this, I want to know, can I just solve before because it's fewer steps? No, I can't. I have to solve before and after, because if I solve before and I get 24,000, it could still be either of these. And if it's all before and I get 30,000, so it could be either of these. But if I take another piece of knowledge in there and I say, well, what is the difference in after between these two and between these two? Lo and behold, the difference is $200. Is there a $200 somewhere in the problem that we can see right here, like, maybe around here parts? Oh, suspicious. It's about to be tossed off the ship in Among Us. It's pretty sus. So $200 there is a difference. And you might be thinking, well, in the past, we picked the one that included raw material, so it's higher, right? So we should probably pick the one that's $200 higher. I was about to trick you there. Think about the logic. We want RIP to include this raw materials cost, debiting it over to RIP. And if you get that wrong, you don't include it, then you get the answer wrong because you made the RIP debit lower than it needs to be. You didn't include the portion of RIP. Well, if you increase the RIP, the debit to RIP, you also have to increase the credit to COGS when you're backflushing, which means that by incorporating this $200, you actually need to reduce COGS by $200 more. You're crediting COGS $200 more than not. So I know this one's wrong because it's $200 higher than this one. I have suspicion that this one's wrong and that this one's wrong. So if I just had a guess, I'd say it's between B and C right now. Those are the two that are $200 less, probably because the professor's trying to see if I will correctly credit away that $200 from cost of goods sold to be debited off to the portion of RIP. So it's B and C. I got to figure out what now look at that. By knowing the logic of backflush, so I'm by just understanding the logic of backflush and trying to get in the head of the professor, which I don't mind that we are in a profession that relies on its highest credential that depends on multiple choice questions, the CPA exam. By and large, a lot of multiple choice questions. So test taking skills, they're part of your profession, like it or not. I don't mind, letting you have a little practice of, well, how does a test taker tend to do these things? Because that's what you're going to do. You get in Becker for hours and hours and hours, and part of what they're going to do is show you old test questions, and you're going to know basically the names and firstborn children of the test makers by the end of that, because you've seen so much of their writing of test questions, you get kind of in their heads. So I don't mind going through this how do I logically increase my odds, test taking skill kind of portion of the class. All right, so it's a B or C, I think. And so now I really could make a really solid guess, probably 80 to 95% certainty just by solving the before COGS. That's a simpler task than doing the after COGS, right? We did, remember? Before COGS, boom. After COGS, boom, at the end. Let's see if we can do that. So before COGS, we're going to take all of our product costs and add them together. Now, we are under throughput accounting. So what cost or costs are we adding together? Just direct materials. Direct materials plus nothing. Like direct materials is going stag to this party here. Sorry, that's it. Sorry you didn't have to do more calculations. Yeah. So okay, well then I think it's C. So again, there's a pedagogical logic here of if you know these factoids, these sub-learning objectives about backflush and lean accounting in general, you can get to a very good guess without doing a lot of the grunt brute force calculations. I know it's throughput accounting, so it should be only including this before COGS. I can rule it out to this and this. Well, those two differ. The after COGS differs by $200. Probably the one that's $200 lower incorporates the portion right there. So I will go ahead and go through the calculations, the brute force. So this is the elegant solution, or in chess they'd say double exclamation point. And over here I'm going to do the brute force solution. Well, they don't have a brute force notation. All right, so I'm going to start with 24,000. That's my COGS before. And I'm going to have to debit away a certain amount to account for 250 units. So let's start with the number of units. So equals 150 plus 100 units in FG and in process to account for. I need to figure out a rate. So let me go ahead and put that in here. Total units is 6,000. So 6,000 total units, which means that the rate is $4. This is the total cost per unit. Again, because the only, here, let me do, it's fine. That COGS before is entirely about the direct materials, total direct materials balance right here, since we're in throughput accounting. I'm just going to use it in this case. And so I'm going to multiply right there. This is my debit for finished goods and IP, meaning IP portion, in process portion of RIP. And I need to make sure I add in $200, the portion for RIP. So this is the total debit during backflush, or in the backflush entry, I'll say it that way. So I take this before, subtract away the total debit, and that is my COGS after backflush. Great. So look, I've double checked that this is the right answer now. I'm just kind of randomly picking colors. There's no rhyme or reason to that. In case you're worried. What does that mean? It means I felt like orange for that square. That's what it means. All right, so here's a conceptual question. There are a few of these sprinkled in, not a lot. There are a few of these sprinkled in. Again, I don't think I need to ask a whole lot of conceptual questions because so many of the calculation questions rely on you having a decent and solid understanding of the concepts so that you can get that proper flow chart in your mind of how to solve them set up. So a firm wants to adopt backflush costing. Which of the following is true about backflush costing? So is it true that backflush costing is not easily combined with direct or variable costing? I hope not, because like 4 of the 10 questions here have attempted to use backflush with direct costing. Okay, B, is it true that backflush costing is not easily combined with throughput accounting? Well, again, we got 3 questions on this quiz that try to combine backflush and throughput. Okay, so I know it's not A and B. Those are not true. All right. C, is it true that backflush costing helps firms keep better track of inventory balances throughout the month compared to other costing methods? I saw a shake of the head as a no. That's correct. It's not true. That's not true. Backflush almost is 99% of the time paired with a periodic system because it's like backflushing at the end of the period. That means you're not tracking inventory balances throughout the period. There are questions on here, which we will get to. We'll try another attempt to at least get that kind of question. It's a different style, which asks you about what is the balance on like the 15th of the month? Okay, well, remember, those balances will not have any backflushing done to them. That happens after the end of the month, the end of the period. We're not tracking very closely what happens in the middle because it's not of use to a lean firm. They don't want people trying to maximize their inventory balances in the middle of the period. Every incentive possible they can take away for overproduction, they want to take that away. All right. So by process of elimination, we know it's the last one. Let's make sure it's the case. Is it true that backflush costing often uses different inventory accounts than other costing methods? And yes, we use RIP and conversion costs as inventory accounts, as opposed to direct materials and WIP. So that should be the true answer right there. All right. So let's consider this question, and I can just vary through the logic of the question, basically come to the answer, I think, just looking at it. So I'm again asking for COGS after backflush, and it's throughput accounting. So under throughput accounting, what is the cost of goods sold balance before backflush? That direct materials amount $75,000. That's it. If it were direct costing, we'd be summing all the product costs in addition to that, which is just these two. But it's throughput accounting, so it's just that 75,000. So is there any way after backflush is going to be higher than 75,000, like A and C are saying? So it can't be A and C. In fact, that probably is the answer. One of those is the answer if we were using direct costing, probably. Because then you would have a starting of 135,000, if I'm not mistaken. 115,000. All right, so it's going to be one of these two. And once again, they vary by 500. Ah, man, I'm giving away the tricks of the trade here. They vary by 500. So one of those probably has the 500 credited away from COGS, and one of them does not. So I'm going to take the lower one. And I'm just going to make that guess. In fact, let's just roll that dice and see what happens. We've done the after calculation 2 or 3 times already. Let's just roll that dice. Now let's shift gears to capacity variances for question 10. And it's good that I have the book here, because you should either reference this book, the book, while you're doing these capacity variance questions, or your notes that you're going to have for the exam, or you can do on while you're doing the quiz, because it's very useful. It's further up. It's on. Make sure you know where it is. It's these 5 bullet points, 8.4.1. These 5 bullet points at top, different definitions of capacity, and these 4 bullet points right below it, the different waste definitions. So first of all, I want to make sure I know management policy waste for this machine on a per day basis. Okay, management policy waste, how is that defined? Management policy waste is the difference between practical capacity and normal capacity. All right? So do we have practical capacity? I think we can with these 2 sentences right here. We can calculate practical capacity per day. So ideally, we can produce a unit every 5 minutes. All right, let's see. Capacity variance question. Management policy waste is the name of our variance, which is practical capacity minus normal capacity. Practical capacity is going to be our theoretical capacity minus reasonable downtime and maintenance. So our theoretical capacity is every 5 minutes we produce 1 unit. All right, well, we have these are units in 1 hour then. 60 minutes in an hour. Every 5 minutes we produce one unit. So every hour we're producing 12 units. Times 24 hours in a day, that's our units in 1 day. That's our theoretical capacity. Now the second sentence here says, the machine supervisor calculates the machine needs 20% downtime. All right, so I want to take that and multiply it by 0.8 then. So we should be able to produce 0.8 of the theoretical capacity units per day. So this should be our practical capacity. Great, we've got one of the numbers there. Over the last few years, the firm has produced an average of 200 units per day. Is that normal capacity? Normal capacity is how much work is usually done by a machine or worker as measured over the long term. That sounds like normal capacity to me then. Yeah, over the last few years, over the long term, it's produced about 200 units per day. All right, so 200 is our normal capacity. If I could spell it. That should be our management policy waste right there, which is one of the answer choices. There are a few that are going to try and trick you really bad because they give you the information to calculate a different variance than it's asking. So a different version of this question might give you all this information here and ask you, what is the budgeted waste per day? And you're like, oh, I can do the calculation. Wait, don't calculate yet. Budgeted waste is normal capacity less budgeted capacity. I don't have anything in that paragraph that tells me the budgeted capacity for this period. I know normal capacity. I know way up here enough to get theoretical and practical capacity. But that doesn't help me at all understand what the budgeted capacity is. So I would have to choose if this said budgeted capacity or budgeted waste right here instead of management policy waste, I would have to pick cannot be determined. These ones are I think there are a disproportionate number of questions, not that a lot, I'd say, compared to the rest of the class, the rest of the test bank in the class. A higher percentage of these questions have cannot be determined because it's one of the primary ways I can test your knowledge about these variance definitions. Meaning, like, if prior questions in the class that had cannot be determined have about between 10 and 15% of them that is the right answer for, maybe here it's 20 to 25% that cannot be determined as the right answer for. Okay? Now let's make sure we get one of those weird timing ones, just so you can see it. Well, oh, shoot. I want to check, make sure we got them right. Oh, no, I lost it. Well, I think we got them right. Oh, well. I think we got those questions right. All right. Oh, here we go. First one. There we go. All right. So this is a lot of words, but we're asking you, what it's really asking is for the timing of backflush. So how do we understand the timing of backflush? During the period, where are the costs accumulated? In COGS, cost of goods sold, yes. And they only go back in, the costs only move from cost of goods sold back to the inventory accounts during the backflush entry, which happens after the end of the period. So this is really hinging upon you knowing that question of timing. All right, so we have $0 at the beginning of May in all inventory accounts. So we're looking for what if you searched in the accounting information system for the RIP account balance on May 15th. Has there been a backflush entry since the beginning of May? No. That'll happen at the end of the period, after the end of May. So you can eliminate this one and this one. You know that the May 15th balance has to be $0. Now, in June 15th, we'll have had that one backflush entry. At the end of May, early days of June, we'll backflush costs from cost of goods sold where they've been accumulated over to RIP. Some of them will go over to RIP. And so we're going to need to have a certain amount we've debited to RIP, right? I know we don't have info here on direct labor and variable overhead. We try to simplify the problem. If we get this 5,000 and divide it by, oh, there it is. I did make a note. Good. No direct labor or overhead cost. All right, so I know it has to be this one. I know it has to be this one by logic of the timing. Because before the end of May, it'll have the same balance as it had at the beginning of May, which is $0. Ripped it. And then after the end of May, it will have to have some amount debited to it because there are some units in process. There we go. Okay, I'm getting it now. 5,000 here, total costs, because we have no direct labor, direct materials, so we're just looking at total direct materials cost. And we have just for note for later, we have 0 raw materials in the period. Divided by 200, so 5,000 divided by 200. This is total cost, and this is units in process. No, total units, excuse me. And so that's our cost per unit, our total cost per unit. And then the portion to RIP is $0. The IP portion to RIP is at 25 times 20, which we got from right here. There are 20 units still in process. So $25 times 20 will give us the 1,000. Will give us the questions messed up. answer. I know what I did. All right, I got to fix that question. This is the one that will accept this correct. This is what we get when we figure out how much we're debiting to RIP when we do the calculation based on these numbers. So I'll fix that typo in that question. Let's double check one real quick before you go. Make sure. I think that's one it'll accept. We get 2.5 points. Yes, we did. Okay. I'll fix the data on this question here, but the logic of it stays the same. We should have a 0, and we should have a positive balance after. All right. Thanks very much. Let me know if you have any questions between now and Friday, but any problems with any individual questions. Email me. I'll try to get back as quick as I can.